Well, thanks for coming, guys. Tonight, I'm happy to introduce you with a friend of mine, Adam Edwards. We're going to talk about something that on the surface is going to sound very, very strange. We're going to talk about using whole life insurance in a different way than I was ever taught, or probably anybody here has ever been taught. It's a way to basically store your cash, a way to build a savings, emergency opportunity fund within life insurance. And then down the road, use that in certain ways. I know that sounds crazy, but I just ask you to, you're here tonight, so you're open-minded to kind of learn something different, something new. And so just ask you to.
Doing it, but we'll see what you have to say.
Maybe.
It's 93.
And Adam, I thought he would be an excellent person to bring to Orbitform because, one, his background is, a very industrial, skilled trades, technical job up until the last couple of months when he decided to go full-time into helping people learn about this concept. I heard Adam on a podcast probably 2.5 years ago. He was interviewed by one of the well-known life insurance advisors out there that I've learned a lot from. And she's like, wow, this guy's a machinist, and he's from Saline, and it's like, wow. So we've become friends kind of since I heard him on the podcast. So welcome, Adam.
Thanks. Quite the introduction, man. So, yeah, first thing, so I'm from Saline, Michigan, so it's about a 45-minute drive from here, just out of Ann Arbor. 40 years old, got a family of four kids, so pretty busy, lots of stuff going on. So what I kind of want to do is, and for one, I don't do a lot of presentations. I usually do a lot of one-on-one conversations, so that's kind of like my wheelhouse or whatever, so I kind of like that there's not a ton of people here, so I feel a little bit more relaxed. But yeah, kind of touching off on what David said. So in short, what I show people how to do is basically you put more money into what's called whole life insurance, right? And it builds up cash value, right? So you're kind of doing it to build that up more than you are for the death benefit, because typically life insurance, most people view it as you're doing it for a death benefit. So if you have a family, you have kids, you want to have some sort of death benefit for it, just in case you pass, right? It's a good idea. So, but what you can do is, and I'll kind of just give a little intro on that, and I'll kind of go into what I used to do at my old job. Like you said, you can put money into this entity, right? And we use mutual companies, so you're actually a part owner of the company. Okay, so when that company has profits, they return some of those profits to the policy owners. Those are called dividends. So you're basically putting your cash into an account that's growing, and it's guaranteed to grow. It's not tied to any stock market or index or anything like that. So me personally, I've always been real conservative with money. I've never been a real big risk taker. So when I started learning about this, I was like, okay, I'll kind of look into it. I'm 3 years into it, and I've totally transformed how I think about money altogether. So, but yeah, as far as me, I've been in the machinist industry for about 20 years. So I worked for a company out in Westland, Michigan, doing automotive prototype stuff. So we had CNC mills, horizontal boring mills. We made a lot of rubber tubes, a lot of plastic parts. So mainly for GM and Ford, when they were developing different prototype stuff, they'd send us stuff to make, to test it out, that kind of stuff. So I was there from 2000 to 2006. And then after that, I got into another position it was actually in my own town, which was nice, so an aerospace position. So been there for 15 years, left about 3 months ago to do this full time, which was a pretty hard decision. So I've always been accustomed to getting a certain paycheck every 2 weeks, it's when you have a family, it's you want to make sure money's coming in and all that stuff. So, but there we mainly do I guess we were considered like a repair shop, so we repair like existing aircraft components, mainly like landing gear stuff, so. Yeah, I brought this in, this is something that we did, in 2012, so the building that we had, they put on a new addition to increase like, manufacturing and stuff, so. They wanted us in the machine shop, we were actually pretty slow at the time, so they said, hey, we got all these big wigs coming in from Germany, because it was a German company. So we want you guys to make paperweights with like the landing gear stuff. It's like, okay, so we made all the prints on our own. So we made just like the base plate. Basically everything on here we made from scratch besides the dowel pins, this clamp, and then these two screws. And obviously these two screws, but like these wheels we made on like a CNC lathe. So, you know, it was actually pretty fun, but most of the stuff that we did was not actually manufacturing, we were just machining, like removing corrosion, stuff like that, so like landing.
Clean out machining.
Yeah, pretty much, but like really tight tolerance stuff, so, a lot of basic machining processes, but like very, very tight tolerances, and having to create like a really good surface finish, so. But yeah, so that was about 3 years ago, my wife and I moved into our second house. So our first house, we were on like a 15-year mortgage. We were getting pretty close to like paying it off. But we had 4 kids, we were kind of running out of room, so we needed to upgrade. Thank you, sir. So I kind of started looking into like finances a little bit more. So like the idea of going from like a 15-year mortgage to where like I was like 5 years away from paying my house off to going into a bigger house on a 30-year mortgage was like, man, like I don't want to do that, but we were just running out of room, so that's kind of what we had to do. So I just started to do a lot of research on like, is there any way to like pay your house off more efficiently rather than just having like a 30-year mortgage on it. So came across this concept. Some people call it velocity banking. I don't know if you guys have ever heard of that, okay? Where basically you can use so you can have your mortgage in place and you can have a second line of credit, right? So you can actually put extra principal payments on your mortgage and it'll reduce the term of the loan and reduce the total interest cost, right? So I started to do the math on that and I'm like, yeah, this actually makes sense. So we got let's call it a second position home equity line of credit. So we had that on the side and we were taking, every 4 or 5 months, we'd take like $5 to $8 grand depending on like overtime and stuff. We'd add it to a principal portion of the mortgage payment. So the balance would go down, less interest, so it accelerates it pretty fast. So I was like, all right, this definitely works. So we did that for about a year. And then I found there's a way where you can actually like get rid of your mortgage altogether and just have one huge home equity line of credit, and you actually use that as like an operating account. Okay, so you have a balance, right, and you hold all your income in that line of credit, you pay your expenses out of it. So as long as you're putting more money in than what you're taking out, you can reduce the balance much faster, and then you're always liquid too. So I'm a big fan of being liquid with money, which most people trap money up, like in their house or in their retirement plans, that kind of stuff. So trying to break away from that, right? When you can break away from that and have access to money, you can do more things and be in control of your assets. So, but yeah, so got into that, did that, got out of my mortgage. I'm in that HELOC, so I'm using that, paying it down super fast. Like doing all the math, it's like, yep, this definitely works. So did that, started getting into researching like buying rental properties and stuff. So I bought a rental property, so I used the equity in my house to buy a rental property to create more income, right? So buy a property, you have tenants live there, they pay you rent, which covers all the expenses, and then you get to keep what's left over. So I did that. So just starting to think differently, right? That's like the main kind of focal point of like, you have to, it's all about how you think. Like, we're trained to think a certain way, right? I'm not going to go into the woods on that, but we are systematically trained to think a certain way, especially with financial stuff. So a lot of people and entities profit greatly off of our ignorance, so to speak. So one of the things I want to touch on is how commercial banks work. Do you guys understand at all how commercial bank, yeah?
Can I just add something?
Yeah.
Just throw-
Yeah.
So you were telling us about the velocity banking and paying out your mortgage,
Mhm.
and that's kind of how you, when you were doing that, you got exposed to the life insurance system, right?
Yep.
Just, I just wanted to help connect that, that's all.
No, that's good, yeah. So that's kind of how I got, how I got exposed to learning, like, you can actually do a very similar thing, which is even more efficient with life insurance, so, which sounds weird, it's super weird, but it's actually a very, very common thing that wealthy people do, commercial banks do, corporations do. It's been around for a long time, so, before the stock market, before 401ks and IRAs and all that stuff, so. Prior to the 60s, that's where a lot of Americans held their wealth, right? They had a whole life insurance policy, so. Yeah, that's how I learned about it, was kind of through that process or whatever, so. But yeah, so basically, what you're able to do is, like I said earlier, you can put money into this entity, right? It's a private contract between you and the insurance company. And we only use mutual insurance companies that have been around for over 100 years. So they're very, very good at managing money, better than banks, better than anyone really. So in a sense, you're giving them money just like you're giving the bank money. So you have income coming in, you give it to the commercial bank, right? Does it just sit there in the bank, or do they use that money?
They're using it.
They're using it, right? It's not just sitting in the vault. So you deposit money with them, they pay you nothing to use your money, and then they loan it out to other people and they charge them interest. And those loan payments come in back to them, and they take that money and loan it out again. They're always recycling and moving money. Money's never sitting stagnant. So you can kind of mimic what banks do with these life insurance companies. So another thing that banks do is they never use their own money. They don't have money. They can't. The only money they can lend out is from depositors. Okay, so what I'm trying to get down is that you should think like a banker. So bankers always use other people's money. Okay. And they don't take risks. So if you ever gone to a bank for any kind of loan or mortgage, they're making darn sure that you're going to be able to make your payments. So they run your credit, check all your financials, all that stuff. So, but kind of going back to like, so you put money in the bank, they don't pay you anything on your money, okay? And they use it. So why do we put money in commercial banks? What's the benefit of doing that? If you had to answer that, what's
There's
it?
no,
Just to store it?
with the current interest rate, there's no reason to do that.
Yeah. Well, just to be liquid, you can, if you know, you're not gonna bury it in your backyard. I mean, some people do, you could, but just to have access to it. So you're giving it to them, and if you need it, you go to the corner bank or the ATM or online banking or whatever, so. So you can kind of, you can do the same thing with life insurance companies. Okay, so essentially, like I said, you're giving your money to the bank. That's exactly what's going on. You're signing over ownership of your money to the bank, and they use it, okay? Now, they owe it to you, obviously, so when you go back, they'll give you cash, whatever, but. So with insurance companies, you can do the same thing. You're giving them money, they're taking that money and they're putting it out to work. So they're always having money flow. It's never just sitting around, so. They're just much better with the money than banks are. So, and they pay you interest on your money too. So that's a huge benefit. So your money should always be doing something. It should never be sitting stagnant, right? Because you're actually losing money, especially if you factor in inflation, which now is kind of getting out of control. So yeah, if you bury money in your backyard or just have it in a bank account a year later, it does not have the same buying power. It's actually worth less than what it was a year before. So for one, you don't want to do that. So you want to put your money to work. It should be always earning interest or growing. So, so the insurance companies, they'll pay you dividends. Like I said, we use mutual companies, so you're actually a part owner of the company. So it's kind of like if you could become a part owner of this company, when they have profits, they return some of those profits to you, which used to be pretty common, profit sharing. It's just not really, not a lot of that going on anymore, but yeah, the idea is you put money into the policy, and you own the policy, okay? So obviously it's life insurance, so it provides you with a death benefit. So you get that obviously, but what you're doing is you're trying to build up your cash value and have it grow every year, right? So if you can keep putting money into that, it's gonna get bigger and bigger and bigger now.
So that growth is just on the dividend from the company?
Well, they pay you a guaranteed interest and then the dividend, they add on top of that, so. But yeah, so that dividend is not a taxable dividend either, which most dividends through like stock companies, you have to pay tax on that, so. So what we do is we just take the dividend and we just roll it back into our cash value. So then you're actually getting dividends on top of dividends and interest, so. But the key to it is this, okay, the key to it is this. You always have access to that money, even the growth, right? So you can take the money out if you want, but you never want to take the money out. You want to borrow against it, okay? So if you have money in an account that's growing, guaranteed every year with no market dips or fluctuation, would you ever want to take money out of that account? No, because you're interrupting that.
You don't have to.
You're interrupting the growth curve. That's the biggest wealth killer, is interrupting a growth curve, so. And that's what, stock market, there's always interruptions, and you don't know when they're gonna happen. I've heard tons of people, even at the old place I worked, where they're getting close to retirement and they just lost a crap ton of money, and it's just like, no, I guess I'm gonna work for another 5 years, so. Yeah, I'm not a big fan of that, so. But yeah, so you can borrow against your account, kind of like your house. So if you have a house, your house is typically going to appreciate for the most part every year. There's going to be dips, but over time, your house is going to be worth more. So if you have a loan out against your house, does that affect the appreciation of your house? No, it doesn't. Your house is still going to go up or down in value, regardless if it's paid off or if you have a loan against it. So these policies work the same way. So. But like I said, what you can do is you can put money into this account. It's going to grow every single year. You can keep feeding it because your money has to go somewhere, right? You have income. You got to put it somewhere. So is it better to put it into a place where they're not paying you interest or a place where they are paying you interest, guaranteed? It's kind of a no-brainer. So if you need to borrow against that, you get money from the life insurance company. They'll lend you money and use your account as the collateral, right? And then it's an unstructured loan. You just ask for it, they give it to you, you use it for whatever you want. There's no loan repayments. You get to decide when you pay that back. And there's certain circumstances where you might not even want to pay it back. You can do that too. So kind of what I'm getting at is you have a lot more control over this asset, right? And it's liquid, so.
So if you have money in an interest-bearing account, say it's making with dividends 5%.
Sure.
But then you borrow money and you have to pay 5% interest. Why does that matter? Why is that any better?
Yep. So let's use, say $10,000, okay? You have $10,000 and say it's just a bank account, and you want to purchase something for $10,000, right? What do most people do, right? They'll either pay cash for it, so they'll take the 10 grand out of the bank, they'll pay cash for it, or they'll borrow money, keep their money so it's accessible, and they'll pay somebody else interest, right? So either way, you're always financing everything you buy. You're either consuming your own cash, which when you do that, that $10,000 is now gone out of your control forever. It will never grow for you ever again, right? So it's better to, like the point that you made, put it into an account that's gonna grow, guaranteed every single year, and then borrow against it, right? So if you're earning about the same amount of interest that you're paying, you could view it as a wash. But I don't tend to focus on that. What I focus on is what will that $10,000 turn into in 5, 10, 15 years, right?
So, I think one of the important points with that is that you're paying down the loan, so the amount you're paying interest on goes down.
Correct.
You're getting interest on, so the amount that's gaining interest is going up. So there's actually over a 5-year loan versus a 5-year investment, there's a big delta in the amount of money, right?
Yeah, so, yeah.
And I think something that's often overlooked here, oftentimes by the promoters of this, is that you have to have free cash flow in your life.
And
Like, you have to be saving money
Yep.
to kind of get this started.
No, that's a good
So-
point, that's,
And I think a lot of times that's not talked about enough.
yeah.
Like, the first thing is a person's gotta be living within their means
Mhm.
and saving already. You gotta have some savings to get the ball rolling.
Yeah, if you're living paycheck to paycheck, this kind of stuff is not gonna work. You have to, there's gotta be a spread between your income and your expenses, so.
But if you're saving $5,000 a year, and the choice is put it into a non-interest bearing account or put it into a high cash value life
Yep.
insurance policy.
I mean, it's kind of,
You're gonna create more
you're gonna
wealth.
create, your money's gonna work for you, it's not just gonna be stagnant, so. But yeah, there's a time element involved in this too, so the longer that you let that money sit and grow, the more it's gonna turn into, so. What I do is very customized per individual with, you know, their age, their income, all that stuff, but yeah, that's, what you said, David, is huge, I mean, you know, some of the people I talk to, they're living paycheck to paycheck, and it's like, you need to clean up some things and get some positive cash flow before you can, for one, even save money to begin with, or invest money or whatever, so. Yeah, that's a good point, man, so. You'd be surprised, I mean, majority of Americans are not, they don't even save 5% of their income, so. So that's kind of what most of the people I work with are people that are pretty conservative with money, that are able to save money, that want to pass on money to their kids or their grandkids. That's another huge thing. So another thing.
Or they wanna support their spouse or their.
Yeah, absolutely. I mean, like I said earlier, if you have a family and kids, you should have a death benefit in force until you die. I mean, term insurance is good because you have it for a certain term, but once that term's up, if you're still alive, you have nothing, and you're 10, 20, 30 years older, so you might not be able to get insurance then. Who knows? So, yeah. So. But yeah, in short, that's kind of the basics on how it works. Now, another huge benefit to these insurance policies is once money is in the account, you will never pay taxes on it again. So it kind of operates like a Roth IRA. So like a Roth IRA is post-tax dollars. So you've already paid the tax on the money, so you put it into an account, you don't have to worry about it later. It's just like that. So,
In fact, some people call it a rich person's Roth IRA.
yeah, it's pretty
Because
common.
the wealthy pour just tons of money into these policies.
Yeah, the odds are the bank that you use probably has billions and billions of dollars in what's called bank-owned life insurance with the same companies that we work with. I mean, that's where banks put all their safe money. So.
But they don't tell their customers that.
No, they're not gonna, I mean, I've talked to branch managers of banks and they don't even understand
No,
that.
they don't know.
That's completely over their heads. So, but yeah, so that's, like I said, a lot of times when I talk to people about this, they're like, why haven't I heard about this? Why doesn't everyone do it? You hear that all the time. It's like, and I go back to, it's systematically not mainstream for a reason, because banks don't make money off of it. If you're not putting your money on deposit with banks, you're taking away from their profitability, right? And their profitability is using your money and loaning it out to other people, so. But yeah, in short, that's kind of the basics on how it works. I try to put in as much money as I possibly can. So they limit you on how much money you can put in there, so. There's kind of a minimum and a maximum. But, you know, the more money you can put into a place where you're guaranteed to earn interest, the better off you're gonna be. Short term and especially long term, so.
I think they changed the laws, because I've done this.
Oh, yeah?
I am doing this.
Oh, okay.
But the policy goes back to the point where it was mutual funds, so it's not guaranteed interest. You're still
Oh.
in the stock market.
Yep.
You can pick which funds and stuff.
There
like
are,
that, but
yeah,
it's-
so there's different life insurance policies or that you can do that. So they're called index universal life or variable universal life, where
This
that
is
money.
a whole life policy, but
Is it with, what's the company that's with, you know?
Prudential.
Prudential?
You had it for a while?
93.
Okay.
Do you have the option to not have that money go into those funds?
No,
Okay.
It's called whole life.
Yeah, that's.
it's a whole life policy. I don't think you can buy that policy anymore.
Yeah, because
They
whole
changed
life
the law.
now, it's, you can't.
Yeah,
do that.
anyway, I set it up
Yeah.
to pay for my kids' college.
Yeah.
That's where I was.
There is one company, I have policies with this company, they do allow you to tie some of your cash value to an index fund, where there's like a cap and a floor, so you have the potential to earn more, but you could have years where you don't earn anything, so.
Right.
But you can turn that on and off every year, like a certain percentage, which is kind of nice, but I don't dabble around in that, I just like the guarantees, that's what I like to know what I'm gonna have, so. But I do a lot of like video content, so I did a video not too long ago where I illustrate how you can, a certain person at a certain age puts in a certain amount of money every year, and then based off of that, you can pretty much guarantee like this is what they'd have in retirement. You don't have to worry about any market dips or taxation, which is huge.
Yeah, I think the tax portion for what you'll have when you get to retirement is huge, because
Yep.
you could compare it to a 401K, and you might have, you might have double the amount of money in your 401K, but you have to pay taxes and all of that. And
Yep.
the government gets to tell you when you have to take it.
And you don't know what those taxes are gonna be.
Right.
Odds are they're gonna be higher than what they are now.
Right. And,
Yep.
am I right in saying that even the interest that you gain on, or the dividends you gain on the cash value,
Mhm.
if you take it as policy loans, you don't have to pay taxes on it,
Nope.
correct? Because you're
So-
basically taking a policy loan, and then when you
Yeah.
die, it's offsets the death benefit.
Right.
Yeah. So the way that you get the money out without paying taxes first is you withdraw your cost basis. So all the money that you've put in outside of the growth, you can take that out first in retirement. You don't pay income tax on that. Once your cost basis is depleted, then you switch over to loans, like you said, and you don't pay income tax on those. And if you've built up a big enough cash value account and death benefit, you can take money out and it'll slowly deplete. You can time that, you can, decide some years maybe I want to take out a certain amount and the next year not so much. You get to determine that. So a big part of it is you're in complete control, which most people are not in control of money. They give control to somebody else, so. And you know what you're gonna have. You know what I mean, so.
What's that do for someone that's like got 2 years left,
Yeah.
or 4 years,
Yeah.
somewhere that's getting closer to
Yeah,
retirement?
so someone like that, you don't have that time frame where you can just get that growth, right? So the younger you are, the better it is, because you can feed it for 20, 30, 40 years, and it's gonna turn into a monster, so. Yeah, people that are closer to retirement, and a lot of my oldest client's 70. So for people like that, it's more of a means they have money sitting around somewhere, and they wanna pass on wealth to their kids or their grandkids. So typically those will be more like 5 or 7 pay policies, where they just dump in a chunk of money for 5 or 7 years, or maybe even 10 years, and then they shut it off. And then you're still gonna get growth, it's just you're not gonna have like that time frame, but it's more or less to pass on wealth to your kids and your grandkids.
But based on someone like Ron's situation, if you guys talked and you learned more about their plans and it still could be a viable option to consider.
Yep.
But you just don't know.
Well, everyone's different, so you have to, like, I spend a lot of time, looking at everyone's finances from like everything, front and back, so, yeah, because everyone's different, everyone's customized.
There's even strategies that, again, these are more advanced strategies where people who have known large expenses, they'll actually build these policies and they'll put the money in the policies first, take
Yep.
policy loans off, pay these big expenses. Now you have your life insurance in force, and it's a little more of a strategic play, but it can make a whole lot of sense. Because if you spend the money, you can't get life insurance. But you get life insurance, and then you can pay the policy loans, your expenses.
The good example for that's like an auto. Rather than paying cash for a car,
Yeah,
you buy the policy, pull the money out to pay for the car, and then you essentially have to pay the loan back.
Yeah.
But that whole time you're making interest on the money that you would have. So you have that ongoing, you have to have that delta to pay the cash for the car or to set it up. And, you know, but there are quite a few people that buy cars with cash and then they just put the payment in their account, like they're gonna buy their next car with cash.
Yep.
Well, instead of doing that, if you did this, you're gonna grow that, you know, $10,000-$20,000 you would have spent on a car is gonna make interest that entire time.
Yep.
And you have life insurance.
Yeah, and you have life insurance.
Well, and the cash value, it works like a line of credit too. So when you make payments, right, that money's accessible to use again. So it's not like a payment to like a third-party lender where that's, once you make that payment, it's gone. So, you know, you can feel comfortable making just random chunks because if you need it back out, you can get it right back out. So it's a liquid account, right? So being liquid is very powerful. That's probably the biggest thing I've learned in the last 3 years is, because before it was like we had a huge mortgage payment. My wife and I, we would always buy like lease turn-ins. When we buy cars, so we'd put down like 20, 30, 40%, have a small payment, and then we usually just pay it off. But now we just pay cash for the cars completely, and then we just make payments back to our line of credit. If we need it back out, we pull it right back out. So, and maybe there's certain months where I don't want to make a payment. And I know I have a big chunk of money coming in 6 months or 12 months, and I can just wait till that comes in and just plop it in there. And then my balance goes down, and it's available to use again. So the more you can untrap money and be in control over your assets, the better off you're going to be and the more things you can do. So typically, you know, where do people have money trapped up? Like their house, their retirement plans, right? I talked to a ton of people that, you know, they're a little bit older and they say, yep, my house is paid off. It's like, awesome. You don't have a house payment. Cool. What if you need to pull some of that equity out? Well, you can't unless you go to a bank and you go through the whole refinance process, all that stuff. So it's just, I don't know, it's crazy. But yeah, you should always be as liquid as possible. Even if you don't need the money, just have access to it. So, yeah, your question is, I mean, it depends on what your situation is. So if you have a spouse, if you have kids, grandkids, you know, what are you planning on doing as far as passing on wealth to them? You know what I mean? So those are the kind of questions you would want to look into, you know. And having a death benefit in force is huge. And, you know, that's when I go back to the term insurance. Like, it's heavily promoted that you should buy term insurance for your working years, which that's a good thing. You should have some life insurance, but what happens when that's up? You know?
Well, you're wealthy, because Wall Street's got
Yeah,
you
you
wealthy.
should, yeah, supposedly.
But it doesn't. But it doesn't.
Yeah, supposedly. But, yeah, the more, going back to the taxes too, this is such a huge aspect to this. The more money you can put into an entity where you never have to pay tax on it again, that's pretty powerful, big time. Because that's a huge expense that people just don't factor into.
So say someone's retiring the 401K, can they
Mhm.
roll some of this into?
Yep, so
Or-
terminology, and I'm not securities licensed, okay, but I can give opinions on that kind of stuff. But you can't roll over money from a government retirement account into a life insurance policy like you could, like if you leave your employer, you roll it over into the next employer. You can't do a rollover. But you can, if you're getting income from your 401K, that money has to go somewhere, right? So maybe you want to put it into an insurance policy where it's going to start to grow and then create a death benefit too. You know, so I always ask people the question, you have money coming in, always. Where's the most efficient place for that money to go? But yeah, if you have 401K income, or if you can take big chunks out of that if you wanted to, I mean, you're always going to have to pay tax on that money.
Right.
You can't really avoid that, unless it's a Roth IRA. But Roth IRAs, you can only put in like $6,000 a year, so you're just not going to build substantial wealth on that. But yeah, with a 401K, a 403B, those kind of plans, or a traditional IRA, you know, if you're over 59 and a half, you can take money out. You're going to have to pay income tax on it. You can't avoid that, but maybe you wanna take some of that money, and maybe you wanna put it into an insurance policy.
My wife just started a new job this week, and it has a
Mhm.
403B,
Yep.
but I know nothing about it.
Yeah, 403Bs are just like 401Ks, but they're like,
She had a 401K for 30 years, but it's like,
yeah,
you know, it's kind of sitting there now till we decide what.
yeah. Yeah, my wife, she has a 403B, she works at Mott's Hospital at U of M. It's just like a nonprofit version of a 401K, pretty much. But same thing, it's invested with mutual funds or index
I
funds.
think what Adam's trying to explain here, Ron, is like when you retire and start taking money out of your 401K, when you reach age 70, I think it is,
It's 72 and a half now, they just
Okay.
changed it, yeah.
72 and a half, they take whatever, look at how much money you have in your 401K, and then they estimate your life expectancy from that point, and divide that amount, and that's how much you have to take out of your
Yeah,
401K.
it's called RN, like
You have to
required
take it
minimum
out.
distribution. If you don't, there's a 50% penalty if you don't take out the minimum.
So if all that money, that's way more money than you're spending, this is a place to put it.
Yeah.
That's why you said there was limits what you could put, but I don't know how much you could put or what.
Right.
Yeah, so it kind of depends on, so the biggest thing is that the insurance company is looking at your age, your health, and your income, or either your assets. And they'll allow you to put in a certain amount of money based upon those things. We're able to get creative with underwriters with certain things. But this is the question I get all the time, like, what if I have like $500,000? Can I just put that in there and just let it sit? No, you have to, it has to be spread out over a certain time frame. In the 80s, people used to put in like wealthy people would just put in $1 million single premium, boom, just to get it off the radar to never pay tax on it again. And then Congress and the IRS were like, all right, that's too good, so they said you have to spread it out over 7 years. It's called the seven pay test. So, but yeah, it's dependent upon your age, your health, and your income. So they're looking at you as
So
what kind of.
that's just the 401Ks that do that?
Yeah.
What about IRAs?
IRA's same thing.
Traditional IRAs, yeah.
Any other
Because I
government.
remember talking to Butterfield not too long ago about my wife's account,
Yeah.
because their job was going away, well, it hadn't yet, but it was going away. You know, what do we do? He said, well, we could set up an IRA, this, that, but I don't know.
It's a
that much.
similar retirement
It's the
fund,
same
it's
thing.
gonna have the same government handcuffs.
Yeah, government qualified plans, keyword government. They're gonna get their share of it, so. Yeah, so I used to have 401Ks, it's all out, every penny's out. And I did pay taxes on it, which I'm gonna pay taxes eventually, so I'd rather pay now than later, because it's probably gonna be lower now than later. But all my retirement income, everything will come, I have 4 policies, it'll all come from the policies. And I'll know what I'm gonna have, and I can control it throughout my working years. You know, like 401K, depending on your employer, you can maybe take loans from it. Some employer, like my employer, you could not touch that thing. So last year you could, and I did. Through the CARES Act, they allowed you to take money out before you're 59 and a half, but yeah, so.
So Adam, what excited you about, starting your savings plan within whole life insurance policies? Like what excited you and captivated you and made you want to just do it yourself?
Yeah, there was a few things that when I started to read up on it and really just think about it, a big thing was the fact that you can, like I said earlier, you can put money in, you can borrow against it. And seeing how that, if you're not interrupting a growth curve, it kind of goes like this, and it just, that was super appealing to me. The fact that when you do that, when you take those loans, they don't ask you what it's for. They don't say you have to make payments every month. They just wire it into your bank account. And then, like you mentioned earlier, let's say you have an outstanding loan and you die, your death benefit covers the balance and the rest gets paid out.
And ideally, when you're doing that, you have some kind of investment idea. that is gonna perform better than your policy loan interest rate. Right, I mean, you
Yeah.
can use it for normal life expenses too,
Yep.
but,
Yeah.
but the real magic happens when you build up your cash value, and then you start looking at investment opportunities.
That's a pretty in-depth, yeah, we can go in the woods with that, but I'll try to simplify what you're talking about. I like to use the example of.
You don't have to.
No, you can do what banks do, okay, like I said earlier. Banks buy and sell money, right? They buy your money for free essentially, and they loan it out to other people. So let's say that they're paying you 1%, okay? And they loan your money, so you put money on deposit with them, they pay you 1%, and they loan it out and they make 2%. What is the spread that they're making? How much profit are they making on that? Percentage wise? What would be your guess? If I gave you $1, you gave me $2 back, what's my rate of return on my dollar?
$1.
100%.
100%?
Yeah.
That's what banks do, okay? So they're paying us nothing, they're loaning money out at 4, 5, 6%, do the math on that. That's not even factoring in fractional reserve lending through the Federal Reserve, that's a whole other, that's even juicier than that, but, so
So what's interesting is, and again, I don't wanna get too highfalutin here, but, so you might say you have an investment that's gonna be $100,000. You think it's gonna return 10%, okay? So it's easy to think about this process. You go get a policy loan and you're gonna pay 5% interest rate, okay? So if the investment turns out after a year, you've got a loan for 100 grand and it's grown, you've earned 10,000 from it, and you paid the life insurance company 5,000. You bought their money for $5,000, but you've gone up 10,000. So you haven't taken 100,000 to earn 10,000, you've taken 5,000 to earn 10,000.
yeah, you've used
You're
$100,000
acting like a bank,
of
you
somebody
use
else's
other
money.
people's money. But you can't, this vehicle, whole life insurance, is so interesting because lenders know how solid these companies are. It's
Oh,
the
yeah.
best collateral you can get. It's
You-
way better than your house.
You can go to
As
a
collateral.
commercial bank, and if you tell them you have cash value, they'll lend you money in a
It's done.
heartbeat, because they know it's guaranteed. That's why they put billions and billions of dollars in life insurance on all their executives. They have
It's
a
just- it's
bunch of
subtle, it's
executives.
subtle, but it's, and so if you cascade that through other areas of your life, and you start, if you take on this process and you believe in it and you buy into it and you have savings, what happens is you want to figure out ways where you can get more money in your policies.
That's my
And
only
then you
problem.
use
I
that
don't
money
make
to
enough
pay for
money.
your other expenses, because you want
I
to
say
build a
that every day.
snowball. 'Cause once you get snowball going, it just keeps growing.
Yeah,
But you gotta get it growing, you gotta get it started. And I think we just aren't really taught that. We're not taught the power of compound interest. You know, people say the word, but we're not given a vehicle that we can be confident it can be executed in. Well, this is the vehicle. It's been around for
it's been
hundreds of
around
years.
forever, so.
It's just, but, you know, 1970s, I'm sorry, I'm getting my soapbox. 1970s, you know, this little 401k thing came out, and all it was is a line in the tax code, 401k. It's a line in tax code
Mhm.
that some people were trying to figure out how to defer income taxes for some key executives. Well, then, Wall Street hears about it. Employers don't want to have pensions anymore.
Yep.
So voila, let's put all the risk on the people.
Always.
And,
Always.
and people in this room didn't invest in Wall Street in the 1950s. You just didn't. There were no mutual funds.
Yeah, they made it. they
Now
made
there's
it
more
sexy.
mutual funds than there are companies on the stock listing.
And those
doesn't
companies
make any
aren't,
sense.
they haven't been around for long and they probably won't be. So that's why these insurance companies we use are like 150 years old. You know, they've stood the test of time, so.
This has been something that, I know I get excited about it, but since 2017, I've been very fortunate that I've been able to spend a lot of my time researching investments for our family, for the Turkey family. And this is the one thing, that if I could only have learned one thing, is this.
Yep.
Because this is the foundation. And so like,
And it's really.
It's hard to
yeah,
describe
it's
and hard
al-
to share.
And it's also really important to understand that it's completely scalable. So
Yeah.
when you think about the short
Yeah.
keys, you think about
Yes.
wealthy individuals,
Yeah.
right? And, but what I've learned is that you can peel it back, you can peel it down. Obviously, there's a minimum barrier that we
Yes.
talked about where you have to have some excess. You have to be a person that lives within your means to save, but you can scale it down to whatever. If you're saving $5,000 a year, like I said, this is the means that I think makes sense to do it.
Yeah, I have clients that they're putting in 10,000 a year, and some are putting over 200,000 a year. So it's just, everyone's different, it's just dependent upon what people have going on, so. But yeah.
And they're really specialized policies, so that's the other part, is they're specialized policies to maximize cash value. So if you've ever seen a whole life policy, most of the time, these are different. Because they're
Yeah.
augmented to really focus on cash and not death benefit. Death benefit's there's requirements from the government on a certain amount of death benefit. But it's really as low as it can be while maximizing the cash value portion.
Yeah, typically, like, traditional whole life and the stuff that you hear people trash all the time is you put money in and you have no cash value for like 2 years. You know, you won't break even until a year like 17 or 18. So it's like, yeah, that doesn't sound very good. We can design them for high cash value early on. So there's typically, let's say you put in $10,000, typically within, if you do it in a lump sum, within 30 days, you can have access to between 60% and 85% of that, depending on how you design it. There's different ways you can do it, but you have access to a lot early on. So, yeah.
And I think a lot of times promoters of this, they make it sound magic, and it's not magic. It's just more efficient. It's more efficient, and
Yeah.
it's more efficient from a tax situation. It's more control than a lot of other places to keep your money. It's higher earning on growth, and it buys death benefit. But it's not magic. It's just something to learn about. And
Yeah, like these insurance companies, they don't take risks. So everyone pays premiums. It all goes into one big pool. Out of that pool, they use that money to invest, to create more money, so that they can pay out death benefits. It's guaranteed. It's a contract. So when people die, they have to make sure that that money's there, and it is there. They don't inflate money like banks. Yeah, you're putting money on deposit with them. They're putting it out to work, and you get some of that profit back, and you have access to that money. The only thing that limits you is how much money you've put in compared to how much money you have access to. And they'll give you a loan in a heartbeat. That's the safest loan they could possibly do, because they're gonna get paid back, guaranteed. So, if you die, they'll get it then. If you don't die, they're gonna get their money. So, it's a pretty safe bet, so. Yeah, that's kind of, there's like tons of different, weeds we could go into, and I have some pretty interesting conversations, but,
yeah, well, thank you very much, Adam, for coming.
Thank you.
yeah, like